Most people think investing is only for those with thousands of dollars to spare, but one of the biggest myths in personal finance is that you need a large amount of money to get started. In reality, many investors begin with surprisingly small amounts and focus on consistency rather than size. That's exactly what I wanted to test. I invested just $100 into index funds and built a simple portfolio designed around diversification, long-term growth, and low-cost investing principles. Today we will talk about I invested $100 into index funds. Here's my exact portfolio, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people think you need thousands of dollars to start investing. One of the biggest myths in personal finance is that investing is only for people who already have money. Many beginners imagine that successful investors start with tens of thousands of dollars sitting in a brokerage account. They assume investing is something you do after you become wealthy, not something that helps you build wealth in the first place. That belief keeps countless people on the sidelines. The reality is that modern investing has changed dramatically. Fractional shares, low-cost brokerages, and index funds have made it possible to start investing with surprisingly small amounts of money. That is exactly why I decided to invest just $100 into index funds. Not because $100 would make me rich overnight. Not because I expected life-changing returns. 9. The goal was never to get rich from $100. Before discussing the portfolio itself, it is important to understand the objective. The goal was not to turn $100 into a fortune immediately. Social media often promotes unrealistic expectations. People see stories about stocks doubling overnight, cryptocurrencies skyrocketing, or traders making huge gains in short periods. This creates the impression that investing is about finding the next big winner. But long-term investing works differently. The purpose of this portfolio was to build a foundation, to create a habit, to begin participating in the market. Because the first investment is often more important psychologically than financially. Once you become an investor, even with a small amount, your mindset begins changing. You stop viewing investing as something distant and start treating it as a normal part of your financial life. That shift can be worth far more than the initial investment itself. 8. Why I chose index funds instead of individual stocks. One of the first decisions I had to make was whether to buy individual stocks or index funds. Many beginners are attracted to individual companies because the potential gains seem exciting. The problem is that individual stocks carry significant risk. A company can perform poorly. Management can make mistakes. Industries can change. Unexpected events can impact performance. Index funds take a different approach. Instead of betting on one company, an index fund owns many companies simultaneously. This diversification reduces risk because the portfolio is not dependent on a single business succeeding. Rather than trying to predict which company will dominate the future, index fund investors focus on owning large sections of the market itself. For a beginner with only $100, diversification made much more sense than speculation. 7. My first allocation focused on broad market exposure. The largest portion of the portfolio went into a broad market index fund. The reason was simple. The broader the exposure, the less dependent the portfolio becomes on individual outcomes. Broad market funds often include hundreds or even thousands of companies across multiple industries. Technology, healthcare, financial services, consumer products, industrial businesses, energy, and much more. Instead of trying to guess which sector will perform best, the portfolio gains exposure to the overall economy. This approach aligns with a philosophy followed by many long-term investors: own the market rather than trying to outsmart it. 6. Diversification helps beginners sleep better. One of the most underrated benefits of index funds is peace of mind. When investors concentrate all their money into one company, every headline suddenly feels important. A bad earnings report becomes stressful. Industry news creates anxiety. Market volatility feels personal. Diversification changes that experience. Because the portfolio contains many companies, the impact of any single company becomes much smaller. This reduces emotional decision-making, which is often one of the biggest enemies of successful investing. The goal is not eliminating risk completely. The goal is reducing unnecessary risk while maintaining exposure to long-term growth. 5. The real power comes from consistency. Not the initial amount. The most important lesson from this experiment had nothing to do with the portfolio itself. It had everything to do with consistency. Many people focus on the first $100. Successful investors focus on the next 100. And the 100 after that, and the hundreds after those. Compounding becomes powerful when contributions continue. The initial investment matters, but regular investing matters far more. A small portfolio funded consistently often outperforms a larger portfolio that receives no additional contributions. This is why many wealth-building strategies emphasize habits rather than one-time actions. 4. Time is the most valuable asset in investing. The reason index fund investing works so well for many people is not because returns are magical. It is because time amplifies results. Compounding needs time. Growth needs time. Markets experience ups and downs, but long-term investors benefit from allowing their investments to remain invested. This is where many beginners struggle. They want immediate results. They expect dramatic changes within weeks or months. But investing is often a decades-long process. The earlier someone starts, the more valuable time becomes. That is why a small investment today can ultimately become more powerful than a larger investment made years later. 3. Simplicity often beats complexity. One surprising realization was how simple the portfolio actually looked. There were no complicated strategies. No constant trading. No advanced financial engineering. Just diversified index funds designed to capture long-term market growth. Many investors spend enormous amounts of time searching for perfect strategies. Meanwhile, some of the most successful investors in history built wealth through remarkably simple approaches. Simplicity reduces mistakes. Simplicity improves consistency. Simplicity makes it easier to stay invested during difficult periods. Sometimes the most effective strategy is not the most exciting one. 2. The portfolio was really a wealth-building system. At first glance, the portfolio looked like a collection of investments. But over time, I realized it was actually something else. It was a system. Every future contribution could be added automatically. Every dividend could be reinvested. Every month could strengthen the portfolio slightly more. This transformed investing from an event into a process. And processes are often more powerful than goals. Goals provide direction. Systems create progress. The portfolio became a mechanism designed to accumulate assets gradually over time. 1. The exact portfolio matters less than starting. People often ask for the exact portfolio allocation. And while allocations matter, they are not the most important lesson. Because the truth is simple. Most people will never become wealthy from finding the perfect portfolio if they never start investing at all. Many spend years researching, comparing funds, analyzing markets, waiting for the perfect moment. Meanwhile, time continues passing. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.